I'm Dave Henning, Executive Coach with the John Maxwell team, and we're here on a brand new podcast with April Carrillo, a loan officer. And April is a very experienced and knowledgeable person in the real estate and mortgage industry. So we want to ask some critical questions of our listeners and what you would like to know. So April, welcome, first of all. Thank you for being with us.
Thank you. Pleasure.
So April, how long does a typical loan take to close? I think that's a very common question that people are going to ask either a seller or a buyer, and they want to know, hey, if I sign on the dotted line for this mortgage to buy this house, when can I expect to move in? How long is this going to take?
Yeah, that's a good question. So there's quite a few different elements to getting your loan closed. First, it's getting into contract. And so typically a purchase contract, that's between the buyer's and seller's agent to agree to that represent both the buyer and seller of the property. That could take anywhere from 30 to 45 days as a typical contract. And us as a lender, we'll work within that time period. So we make sure that we hit those timelines and those deadlines that need to be established. But there's, credit, income, assets, and appraisal. All of these items need to be done and signed off during that timeline. So about 30 to 45 days.
So there's obviously a lot of people involved. In addition to the bank or the mortgage company, you've got the appraiser. There might be inspections like pest control, perhaps, or different things that come into play. Is that right?
Yes, and that's more on the real estate side. So the realtor is going to have to make sure that all those items are met and cleared. We call those contingencies. And so we'll have a title company that is within this whole entire process. And that title company is a non-biased third party that represents both the buyer, the seller, the lender. We're all there, but they don't take anybody's side. And so they're the ones that are going to help clear a lot of those conditions that are needed throughout the process.
Okay, great. And of course, documentation. People have to prove that they qualify for their new mortgage.
Yes.
And what's involved with that? What kind of documentation can people expect to have to provide?
Yes, good question. This can range depending on what is going on in that individual's life. For instance, if I have a husband and wife, this is their first time purchasing a home, then we're going to typically start collecting 2 years W-2s, 30 days worth of pay stubs if they're a wage earner, or if they're self-employed, we will get 2 years of their tax returns. So we can work backwards and identify what their overall income is. We'll also have them sign a borrower's authorization form, allowing us to pull credit, so we can take a look at what their overall monthly debt is. So we can do some calculations called a debt-to-income ratio that will allow us to understand how much they're able to borrow in order to get the purchase that they're looking to do. We also will collect 2 months worth of bank statements, or maybe it's a 401k statement. These are always going to help show proof that they have enough reserves or enough the down payment in order to accomplish what they're looking to achieve. But we can go further on that. Sometimes we have individuals that maybe this isn't their first time buying a home, and they are buying a second home. Then we'll have to kind of dig in and dive in and see, well, what do they want to do with their existing property that they live in? Maybe they want to rent it out. And then with that, we'll ask for their current mortgage statement, current homeowner's insurance, current property tax bill. And we can include that and then allow them to claim rental income on that property. So that can help wash out that liability. So they'll have more freed up income and cash flow for their new property.
Well, that's fantastic. So April, typically in the past, it seems like the down payment that you mentioned was somewhere around 20%, if not 20% exactly. But what are the options nowadays with a modern mortgage?
Yes. So there are so many great programs out there for borrowers. We'll really meet them where they need to be based on what they're wanting to achieve. And so we will start with, of course, conventional and traditional financing. With that, it'll allow them to do as little as 3% down for conventional for a first-time home buyer, 3.5% down for an FHA loan. That's a federally insured loan that allows for a little bit more flexibility there, but it's insured, so it'll have some private mortgage insurance attached to that for the life of the loan, and that's just a monthly monthly payment that'll be included in the mortgage payment that protects the lender, just because it's more of a risky loan for them to take on, and in case of foreclosure. But really, you're looking at 3 to 5% down. That's your typical, but it will always help with private mortgage insurance. It will help with your overall interest and your overall payment the more money you put down. So, we'll look at all options for that.
So that's what PMI stands for, private mortgage insurance?
Correct.
Does that extra payment ever drop off of a mortgage, or is it for the life of a loan? And secondly, are we looking at primarily a lot of 30-year mortgages, 15-year mortgages? I have another question after that.
Yeah, that's actually really good points to focus on. So private mortgage insurance, depending on the program. So for instance, on a conventional loan, which you're talking about Fannie Mae, Freddie Mac, these terms, necessarily a borrower is not going to know, but your lender needs to know these, and we'll walk you through this. But on conventional loans, private mortgage insurance will need to be carried if your loan to value is more than 80%. So if you're putting down 85%, if you're buying a property and you need to borrow 85% of the purchase price, or 90, 95, that's when you're going to carry private mortgage insurance. And once you pay down that mortgage to represent 78% of the loan amount of what your property is worth, you can call up that lender and they can drop that mortgage insurance. That's on conventional.
Wow.
However, if you're going FHA, you will, that's the one that will allow you maybe to have a lower credit score, more debt. It's going to be a little bit more risky. You only have to put down 3.5%. These are all great things for a borrower to realize their purchase and get into their purchase, but it's a little bit more risky for the lender. And so what happens on those ones is that borrower will need to carry mortgage insurance from the time they get the loan all the way through until they refinance out of it. So we will look at those factors and really identify that we're putting that borrower in the best position. So we'll do it a plan A, plan B, and then present those so they can have the best option moving forward.
So those are some of the different options on what a mortgage is structured like based on variable down payments. Do mortgage lenders still offer these 5-year balloon mortgages? I know that seemed to be a real problem in 2008.
Yes, good question. Yeah, so regarding mortgages, typically you're going to see these days more of just 30-year fixes, 20-year fixes, 15-year fixes, no more 2-3 years. You're looking at 7-year. They'll have 7-1 arms, which means that it's fixed for 7 years, but on that 8th year, it will go adjustable. And, every loan program is different, and so we would explain that on that side. But typically, you're going to see 30-year fixes. You're not going to see balloon payments anymore, something that's, 30 years due in 15, and then on that 16th year, you have to pay $300,000. You typically will not see interest only or 40-year payments, negative amortization payments, interest only. A lot of these just really didn't put individuals in the best position. But they, if it's an investor, if it's somebody that needs a little bit more flexibility, we do have some programs that would fit that as well.
So you mentioned refinancing, and what are some of the options for people that are in an existing home and refinance? And along with that, interest rates historically are still relatively low.
Yes.
Compared to the 18% mortgage I had back in the 1970s.
Crazy. Money is cheap right now. Yeah.
Yeah. So why would somebody want to refinance, or should they? And in conjunction with that, if they're remodeling a home, and can they still take money out of a mortgage towards construction or refinancing. I mean, remodeling.
Yes, yes. It really, it is so important to understand the leverage a homeowner has with the equity that they have built inside their home. It's one of those things, as a lender, we'll walk you through on how to unlock that equity and really itemize and see what you want to achieve. One of the best things to do is if we do have someone that owns a home that has some equity in the property and they have a bunch of credit cards that maybe it's just getting a little overwhelming, or they make their payments on time, but they have that 18 to 22%, 26% interest rate on those credit cards. Well, mortgages these days are 4 or 5. 4 to 5%. So if you can think of maybe you have $30,000 worth of credit card debt, but you have that much equity, in your home, why not refinance? Put it into your, pull out that cash, that equity in your property, pay off those credit cards, and now you just have one mortgage payment that you're making. And now how much savings did you shave off every single month from your mortgage payment? And now you're paying one payment at 5% rather than 10 payments at 20.
So financial freedom is always good.
Absolutely.
And so closing costs. Tell us about how closing costs fit in. Sometimes, at least in the past, my experience has been that the seller would pay some or all of the closing costs, or on refinances, it's supposedly no closing costs. What you really know, there is something there. Right. So tell us about closing costs and what does that mean and how does that apply?
Yes, so closing costs vary, but typically you'll see that there's closing costs such as underwriting fees, there's title fees. These are all disclosed early through the process in your initial disclosures. They'll be completely spelled out for the borrower to really understand about how much it's going to take to achieve what they want to get out of this mortgage. But a lot of costs are sometimes associated that maybe $1,100, $1,200 when you're talking about just underwriting and title and all that. But then there's cost too. You'll hear cost on the front. We know, I want to get a 4.5% with a 1 point cost. What that means is that it's going to cost 1 point to get that interest rate. 1 point is equal to 1% of the overall loan amount they're getting. If they get a loan of $400,000 and they say it's going to be a 1 point cost, that's $4,000. Lenders will then be able to add that into the loan itself. So now it'll be a $404,000 loan. And then paying the interest on that. So you can wrap it up into the loan so it's not out of pocket up front, but you're going to want to ask your lender or anybody that you're choosing to work with that they really make sure to disclose to you how much it's going to really cost. And there is no such thing as a free mortgage.
Right.
You are paying for it in some way, but most of the time it's just wrapped up into your loan, and so you just feel it a little bit every month on that mortgage payment you're making. But we try to keep those costs relatively low, but there's always an option if you see that you want a 4.25 instead of that 4.5, you're going to pay a little bit more to buy down that rate. So those are really what you're looking at. And the other question that you had is, do you have sellers and buyers during a purchase? Who's responsible? You'll see a lot of the time that the seller who is selling the property to the buyer is willing to cover quite a bit of their closing costs. And that's something that they'll need to talk to their realtor to work out that contract.
Okay, great. Now, one thing that we really didn't touch on yet, but there are a lot of people in this area that are self-employed, and they're in a whole different category, relatively speaking, I guess. Yeah. So what's the story on self-employed folks that are looking to purchase?
Absolutely. We run into quite a few borrowers that are self-employed. They're entrepreneurs. They're doing their startups, or they've been owning an auto body shop, anything of that nature. What we do is traditionally what we'll do is just take a look at their last 2 years' tax returns. But so many times we run into business owners that write off so much, and that's what they need to do, so they're only paying what they really need to pay in taxes and not paying over.
Right.
And so that's their right to do that. But when you're buying a house, it doesn't look so good. And if you don't have enough money coming in to show and you're writing off too much, traditional lenders will not be able to do that loan. But with us, we actually have additional programs that allow for us to help those borrowers. So we can do a bank statement program. We could do a 12-month bank statement program or a 24-month bank statement program.
Mm-hmm.
What this allows us to do, and instead of turning in your tax returns for 2 years, you're going to turn in 2 years worth of bank statements.
Oh. Mm-hmm.
And then we're going to add up all those deposits. We don't hit you for NSFs. We don't hit you for any of the withdrawals. We take a look at those deposits. And if you're turning in personal bank statements, we'll take 100% of those deposits and give you credit per month of how much average per month of what you make. Or if you have business bank statements, then we'll take 50% of that. But typically 50% of business bank statements is a heck of a lot more than what's showing on your 1040s. That makes all the difference. And now you can buy that property that you're looking to purchase.
Okay, great. Now, I'm sure you have a certain number of people that come to you that may have had perhaps a difficult season in their life, and they had a foreclosure or perhaps even a bankruptcy. What does it look like for them proceeding forth, trying to move into their new house?
Yes, absolutely. We have, you'd be surprised, we have quite a few borrowers that, they've reestablished their credit. They may even be up into the 700s, but they still have that lingering bankruptcy, or short sale or foreclosure that happened maybe only 2-3 years ago. And they think that they just cannot get a loan. They're, wanting to purchase again or just wanting to refinance and get out of something that they were put in back in 2005 or 2006. And they just need to get in a better position. So with that, we do have programs that will allow for 2 years out of BK or foreclosure. Typically, traditional lenders want to see for FHA, you want to see at least 3 years. For conventional, they want to see 4 years. But we'll have programs that can do as little as 2 years. And if they absolutely need it, we have a lender that will do 1 day out of BK or foreclosure.
Really? So the 7-year rule doesn't necessarily apply in this situation?
Absolutely. So they could still show it on their credit report. The bankruptcy will not come off of their credit report for a period of 7 years. But you really don't have to wait 7 years to get a loan. You could do it as little as 1 day, if worst case, but typically you want to see 2, 3, or 4 years.
And in our area, obviously, we have a lot of renters who are perhaps first-time home buyers. Tell us about how that works.
Yeah, so first-time home buyers, typically with most lenders, that first-time home buyer will get a slightly better interest rate. They may be able to get into the Home Advantage program with Fannie or Freddie, depending on the criteria. But there are some great first-time home buyer grant programs out there. And as long as the grant is being given through a government agency, and they take a class, it's an online class, really only takes less than an hour to complete. They get their certificate as a first-time home buyer. It just really explains to them the process of buying a home. And once they get that certification, they would submit that to the lender that's approved with that government agency, and then they can use the grant money. So sometimes that means that maybe it's $7,000 put towards closing costs. These are great benefits for first-time home buyers. And as a lender, we'll work with those government agencies to make as much of closing costs available to them.
Okay. And the price of housing, regionally speaking, is quite variable depending on what area you're in. So there may be some areas of this region that are typical to other areas in the country where you can find something for 200, 300, 400, 500,000.
Yes.
And then you've got some very niche areas or niche, depending on where you come from, how you say that, that a 2-bedroom, 1-bath home might be 1.2 million.
Right.
So what's the effect on that as far as the mortgage industry goes?
Yeah, so you'll see the properties around here in Silicon Valley especially just keep skyrocketing, right? They keep going up. But as lenders, we have quite a few programs that can really meet the loan amounts that are needed within that area. And so with conventional, you have a loan limit. You go up to $417,000 is considered conforming. You'll hear conforming. Super conforming is when you have other areas that are high priced, like Silicon Valley or Los Angeles, San Diego, and throughout the country, you have high priced areas. Then you'll look at super conforming. So in San Jose, super conforming is up to $636,000, right? So you have these, these little nuances to know. And again, this isn't up to the, borrower to know. We will guide that borrower through, what makes the most sense and get them the best rate based on those loan amounts. But each lender is stronger, at those. So you have conforming, you have super conforming, and then you have jumbo. Anything above that super conforming level, 636,000 is considered jumbo, and that's going to be a jumbo rate. It's interesting because that's unconventional. But if you were to go to FHA with your 3.5% down, it's federally insured, carry your mortgage insurance, much more flexible on FICO, on your credit score, down payment, so forth and so on. You'll have to look at, and the lender will have to look at what county you're looking to purchase in. And this really changes and varies quite drastically just in California alone. An example, where in San Jose, you can buy up to a $636,000 loan amount with FHA with 3.5% down. However, if you go to Fresno, that loan amount is $281,000.
Really? That's quite a variance.
It really does vary. So it's going to be really important that you just make sure that you let the lender know what area you're looking to purchase in, so they can do the work and make sure that they're giving you the proper information on the loan amount that you qualify for, the least down payment.
So April, talk about credit scores a little bit.
Yeah, credit scores. And I know a lot of people have gotten hit, with everything with the housing industry, housing market that crashed. The people have rebuilt, all right? They've reestablished credit, but maybe they still have some nagging stuff that's on that credit report that just hasn't, let their credit score go up, what they want to do. So somebody thinks, oh my gosh, I need a 680 credit score, I can't qualify, is actually not true. Individuals as low as a 500 credit score.
What? Really?
Can get a loan. But again, looking at that criteria, typically you need at least 10% down on an FHA loan to go as low as a 500. The VA program I had mentioned goes down to a 560 credit score, and that's a 0 down for a veteran.
Wow.
So those are some of the caveats. If you're going FHA and you only want to put 3.5% down and not 10, then you'll need a 580 credit score. Conventional, there's really no credit score criteria. It's mainly based on more of an algorithm of your overall credit health, income and asset profile, and how much you're willing to put down. But typically you want to see at least a 620 credit score for conventional, but that's not written in stone. There are some variations we can do, and structuring we can accomplish, but you're wanting to at least have a 620 for conventional. And when you're looking at, say I have a husband and wife that's qualifying, and the husband has a 660 credit score and the wife has a 700, most of the time we'll take the lower of the two credit scores to qualify them on that loan. The lower of the two. And so we'll take that 660 to qualify them. In some situations, if we're working with a more alternative lender that's maybe using a bank statement program, they'll sometimes allow us to be able to prove that the primary wage earner, the breadwinner in the family, let's say in this case that it's the wife with the 700 credit score, that will be able to use her credit score for qualifying instead of the 660. So we have some maneuvering and work arounds there, but typically you're going to run into the lower of the two borrowers being used. But again, the breadwinner could be used in that regards.
Sure. Okay, great. So April, once upon a time, people had first and second mortgages to bundle together to qualify for the down payment portion or whatever. Is that still used at all?
Yeah, actually, it is used. You won't see more of like the 80-20, 80% down with one lender, and then you get the 20% on the other, making it 100% financing. You don't see 100% financing out there unless you're a veteran there. But we do have 80-10s. We do have 80-15s. And why this is used, it's more of a structuring tool to help that borrower avoid private mortgage insurance
PMI
with a conventional lender. So, we'll do a 90%, and then we'll have the second of 10%. So since they're split up, you're still getting 90% financing, but you don't have that private mortgage insurance payment.
And there's a possibility that someone could pay off their second mortgage at some point.
Absolutely right.
Since it's a smaller amount.
Exactly right. Yes.
Okay.
So They are used, but it's more of a structuring tool.
Okay.
So if it's needed, then we'll evaluate, how much, what's the interest rate on that second versus the first, or does it make sense to lump that together and just do a 90% first and carry PMI? What is the difference on payment and how much is it saving that borrower?
Okay, cool. So talk a little bit about, I think the assumption, at least in my mind, has been single family homes. However, in our area, there are a ton of apartments and condos.
Yes.
Talk about apartments and condos and mortgages and how that fits together.
Yes. So interesting. A lot of individuals think that apartments and condos are the same thing. They look exactly the same. Yeah. They look exactly the same. The difference is an apartment is owned by one entity, like a property management company.
Right.
And all those individuals in those units can do is rent. Mm-hmm. There is no way to purchase those units.
Right.
If you buy into a condo complex, those units can be individually sold to homeowners. And so they'll be allowed, just like a single family residence, to refinance, build equity, purchase, whatever, sell, whatever they're looking to do because they own that condo. So individuals can buy a single family residence. That means a house. They could buy a condo. They could buy a 2-unit, which is a duplex. They could buy a 3-unit, a 4-unit. So up to 4 units is still considered a residential loan.
Oh, really?
Yes. And anything above that is commercial. So, and we can help out with that too. But more on the residential side, it's up to 4 units. And with that, if somebody is looking to maybe buy a duplex, what's great about that is they can leverage that second unit. So if they have 2 units that they're purchasing, that first unit would be their primary residence. Mm-hmm. They would own or occupy that. They would live in it. That second unit, during the loan process, we can actually allow them to claim rental income. So, if their mortgage payment is going to be $2,000 on their unit, but then there's going to be a the second unit is going to bring in $2,000 in rental income, we can take 75% of that $2,000 for that second unit and apply it to their income to help them qualify for the loan.
Wow. So there are creative ways to own a home. And let's transition a little bit into investors, real estate investors. You mentioned up to 4 units could be considered a residential loan. More than 4 would be a commercial loan. And tell us how you might work with investors who want to be property managers, basically.
Yes, absolutely. We have, for instance, an example, we have 2 couples, they're family members and they all want to purchase. Maybe they want to purchase a 3-unit or a 4-unit. They can do that. We can help them structure and purchase. Now, if they're not planning on living in it and they want to rent it out, then what we'll do is they're buying, let's say, a 3-unit, and they're going to live in their single family residence still. And they just want to purchase this for a rental property.
Right.
Then as a lender, we will have to underwrite this as a non-owner occupied property. This will restrict or reduce the overall loan to value that they can borrow. Typically, with an owner occupied, like I was mentioning, maybe it's only 3.5% down. Well, on a non-owner occupied investment property, you're typically looking at needing to put maybe 10% down, 15% down, 20, 25% down, depending on the lender to get that. But the good news is that now you have 3 units that you can claim 75% of that rental income towards their overall income to purchase that property. So, there's a lot of leverage that they can, accomplish there, but it's really the lender's job to structure that out for them and really give them the solution that they're looking for and the best case moving forward.
April, it's been great talking with you. A couple more questions if you're okay with it.
Absolutely.
We've got a few more minutes. So, as an experienced loan officer, tell us about the programs that the company that you represent has out there.
Yes. So with our brokerage shop, what we're able to do is quite a few varying. So we can do the traditional, the conventional, the FHA, the VA. We can do all of these loans. We can also do USDA, which a lot of individuals don't know about. It's not beef. Everybody thinks it is. I know. Go to the supermarket. USDA. Kind
you
of
get a
funny.
freezer with your house.
Kind of funny. The government named it that. But this really is a way for rural areas to be developed.
Right.
And so it really gives a great helping hand for those individuals that live in a rural area that want to purchase and build their life in a rural area to allow them to get 100% financing as well. So we have a tool we can look up on the USDA.gov website, put in property addresses or cities and areas that they're looking for, and we can identify. So there's no specific loan limit requirement like there is on FHA. And they allow for 100% financing, but there are income restrictions. So we will take a look at that criteria and just make sure, if you make way too much money, sometimes you can't qualify, right? But a lot of individuals, we're working middle class citizens that, will fit the criteria. So it really has to do with where the property's located is really the focus there. So we do the traditional, the FHA, the VA, the USDA, and then some you call them non-QM programs, all the mumbo jumbo kind of words, but your lender will know this, and this will just allow for those bank statement type of deals or, ways that we can structure. And there's even a stated program out there, believe it or not, kind of crazy. Very low loan to value. So there's really no risk on there with the lender. But those are for your self-employed individuals that have the 700 credit score that are just looking to maneuver their cash flow a little bit. And so we have some outside the box.
Let me interject this quick question. Speaking of the USDA,
yes.
You don't even need to have cows. But speaking of which, what about small farms or family farms or farm property or things like that, or even building lots? Do you do anything with any of that kind of stuff?
We do. We'll touch on it a little. If we are not the a solution for that, we will point them in the right direction. But what we have learned is with vacant land or farms, you're now getting more into commercial side of things, which we have an outlet that we can, a trusted resource that we can refer them to that can answer those questions. But typically, you're going to want, on the residential side, any 4 units or less to keep residential. If you're talking about farms or wineries, anything of that nature, you're going more commercial. But we have a couple of properties right now that we're looking at, and our lender is able to actually, it's a winery. They have houses on the winery, and then they have the winery itself with the vineyards. And they're able to actually split that up and just refinance the properties.
Oh, wow.
And so it now is not a commercial. We're able to now achieve the goals, of that borrower's refinance. So some interesting things that we can do, but typically we'll look at the entire scenario and then come back and find the right solution.
So April, a couple of things. Let's wrap this up with one more question, if I may.
Sure.
And share with us the difference or the value, if there is, between using a mortgage company and a bank, a traditional bank, as well as tell us the name of the mortgage company that you're with right now.
Yes. So I am with Founders Mortgage, Inc. And I've been on both sides. I've been in the bank and I have been on this side now. And I'll just tell you that I feel like there are so many more solutions that I can provide my clients I have answers, for them. I have solutions. We are driven that way, where if we can't figure it out one way, let's try another way. And what I find is banks can be great to work with as well, but I find that sometimes we're only a number, and they tend to cherry pick. They have a lot of business coming in, and so they'll really just pick the people that have the best credit, the lowest loan to value, least down, more down payment, these items. And if you don't get qualified, you don't get qualified, and they move on. They can be great, but I like to know that, I can work with someone that has resources to the bank, so we can get that jumbo 30-year fixed, 3.875, 4%, just like a bank can. But if you don't have the best of credit and you have that BK showing on your, 2 years ago, hey, we can help you too. So it's really just bringing those solutions. And I would say that that's what's unique about working with Founders Mortgage is, I work closely with the COO, James Ling, and it's wonderful knowing that, I have solutions for our borrowers that before I, before I did not. So I appreciate
So
that.
what I hear you saying, just to clarify, is more flexibility with the person you're working with and a lot more programs.
Absolutely.
Exciting. Very cool. So I've been speaking with April Carrillo with Founders Mortgage, and we're really excited to have you as a guest today. Thank you so much for joining us, and we look forward to speaking with you again and seeing what lies ahead in the future. We'll come back, and with your permission, we'll do another podcast.
Thank you. Looking forward to it.
Thanks a lot. Have a great day.
Thank you, David.
Hey, I just wanted to thank you for watching today's podcast. As a bonus, I've got a free book for you by my good friend, David Sharp. It's called Legendary Marketer, How to Build a Digital Marketing Business and Earn Unlimited Income from Anywhere in the World. It's yours for free, just pay shipping. So go ahead and grab your book right now. Go to davehenningcoaching.com and order your copy. And once you order, and there's also some bonuses included that I'm not going to tell you about, you can also access the PDF of the entire book immediately once you place your order. So again, thanks for watching the podcast. Look forward to seeing you again next time. Have a great day.